We have Andrew Thrasher, who's portfolio manager for Financial Enhancement Group, LLC. We're going to take a look at everything within the market, including volatility, sentiment divergence, and a number of other areas. Andrew, it's great to have you join me on MTL. And let's kick it off talking about volatility. It's been relatively depressed so far over the summer. Has not been much to talk about over the past couple of weeks, despite the fact that there are a number of variables in the market. We keep getting kind of news events out of either Iran or from the Fed, and nothing really seems to get a material move. We had a little bit of a pop up to 1440, 1450. May we got up to around 16, but here recently it's been pretty stagnant. I was on last week with Ben, and I said I think volatility's bottomed, and I still believe that's true. A lot of the internal, when you look at other gauges of volatility, when you look at skew, look at the VVIX, the volatility of the VIX, those are starting to rise. You're starting to see a little bit of interest in option activity for the VIX, a little bit out of the money that's being measured by the skew. Looking at put call ratios, you're starting to see some interest underlying. It's just not really rolling over to a lot of what we're seeing in spot volatility or materially into the equity market as well. But I think that will probably change. We kind of have the kindling in place. We just kind of need that little bit of spark that will get things moving. Do you think traders have become complacent or just immune to the fact that there are so many headlines, there are so many tweets, it changes day to day? Someone comes out and has a thought around the Fed and what they should do with interest rates, and they're backtracking the following morning, like what we're seeing happening today on Friday. Do you just think that traders are becoming immune to the machinations with the headlines? I think to a degree they are. The president's been tweeting quite a bit about the stock market. They're getting a little bit immune to what's going on in China. That's kind of becoming old news. Just the same headlines over and over. The Fed, the Fed funds watch that's kind of going up and down with whether we're going to get 25 or 50 basis points, but. We got the pop yesterday after some more dovish commentary, but then overnight that got pulled back. You were talking about that on the last segment, how the Fed's now we're expecting less than 50% of a 50 basis point cut. But we're not really seeing a lot of, the market doesn't really seem to be overly concerned with that. I think we have a lot of catalysts coming up. We have the Mueller investigation, we have the debt ceiling. We just saw Pelosi shot down the last proposal. We have the Fed goes kind of into their blackout period before their FOMC meeting. So I think we have some catalysts where we could see a little bit of uptick in volatility. I think that's why we're starting to see a little bit of buying showing by the skew and the VVIX. So I think those could be the spark to get things going. But right now the market's not overly concerned. We can shoot down drones in Iran, and that still doesn't even get much action. Yeah, I mean, even if you look at the price of oil, we spoke about this on the last segment with Ben, you would think over the news over the past few weeks with all the drones being shot down that you would get that spike in oil, but it continues to just have that resistance at around 61, 62 with 50 at the floor. But when we look at the last leg up in the market, it's not necessarily a risk-on kind of trade. You're not seeing any leadership whatsoever by the small caps. Are you concerned with what's happening in the Russell at all? I am. I think that I would much prefer to have small caps performing with the market. We saw, whenever we have this conversation, a lot of traders will point to the 90s, or they'll point to other periods where we've had extended periods of time without small cap participation. But what I reference back to is last summer, where we really just had the FANG stocks were leading stocks higher in kind of in the summer months going into August, September, and small caps were underperforming. And the market said, that's okay, we don't need the small caps. Until we did in fourth quarter when we had a 20% drawdown. So we're kind of seeing the same thing now where small caps are underperforming, high betas not really outperforming large caps, equal weights not outperforming. Internationally, the four major indexes, you have France, the UK, Germany, you're not seeing breakouts in those markets either. So we're just not really seeing this overly bullish risk on mentality. They're not a chase for beta from equity traders. That's really kind of slow stepping, like you mentioned, volume has kind of been pretty low. They're wanting to own stocks, but they're not really wanting to put way too far out in the water to do so. Yeah, and we're also going into that fourth quarter. It'll be interesting to see if we get that move again, because we really are essentially flat from where we were into that sell-off. Right. If you went to sleep and you didn't realize what had happened, there's a lot of volatility that happened in between. But yeah, we're kind of back. We're kind of having a kind of repeat of last year, where we're getting a narrowing of breadth. It's really kind of the highest quality names. It's again, the tech stocks are really what are shining. Software, we had Microsoft had reported good numbers, CrowdStrike, for cybersecurity. We're seeing a lot of the software names still are doing really well. Right. And so I think when I'm looking at equities, I want to own the names that the market really is showing a preference for. And I think software and cybersecurity are some of those the areas that I would want to have exposure to for my equity allocations. Yeah, well, and it makes sense, because that is the new economy. That's what's leading the way. Right. Software that's just the kind of economy we are. We are no longer leading with the industrial names or the FedExes of the world and so forth. That's really where we are right now. And like you said, if you went to sleep in December and woke up, it sounds great on the headlines. We're up nearly 20% on the year, but we really have not moved that much. Besides software and services, are there any other sectors that you're either completely in love with or don't like at all?
There's nothing that I'm really overly hot and cold on. If looking at, I think consumer discretionary has had a really nice run higher. I think it's getting a little overextended. When you talk consumer discretionary, you're talking Amazon. It's the lion's share of it. So when you look at that, it's okay, what's Amazon doing? They're starting to get a lot in the news. They had Prime Day. That's now behind us. The White House is now coming out discussing the Pentagon contracts to their cloud services. That could have some impact on Amazon. But I think overall retail looks good. A lot of the retail numbers, the broad retail numbers look strong. We still haven't started to see those kind of ease like a lot of the other economic data that has. So I think consumer staples look interesting. Again, I kind of go back to tech. I think it's still a good place to be. It's had a really strong run. I'm not a huge fan of energy. Financials are extremely just tied to the yield curve. So if you're playing at XLF or any of the large banks, you're playing the yield curve. Yeah. And so that's not an area I want to get into.
And if you get that 50 basis point cut, that the chances for that went up yesterday.
Exactly, but then they came back down last night.
Right, so because they backtracked.
Right, and I really think we're not going to get the 50 basis point cut.
Right.
I think we'll get a 25, and I think that could, again, there's so many different catalysts that I think could move volatility right now that I think hedges just look really cheap. We're kind of picking up, I gave a talk to the CMT chapter of Chicago last night, and I said that we're kind of at the point where we're picking up nickels and dimes from a steamroller. Yes. I want to pick up dollars. So when we're kind of in an environment where it's ample risk on, that's the time I want to really put on risk. I just don't think we're there right now. That could change in a couple weeks. Then I'd be more than happy to re-up our exposure to equities.
Because I feel like we're so focused on what kind of rate cut are we going to get, if one at all, but what happens next.
Right.
And that's where the conversation needs to lie. So if we do get that rate cut as expected, if earnings and, second quarter earnings, it's such a tight season because it's the summer, so we only have 3 to 4 weeks. If they are better than expected, and some of them have been, and you get that rate cut, is that the next leg up?
I think it could be, and expectations for earnings are you could barely jump over them to beat them. So I think expectations are really low. A lot of the numbers that have come out have been positive. A lot of the banks were positive. BlackRock missed a little bit on some of their expectations. Netflix faltered, but again, Microsoft had good numbers. So I think software stocks still look good. So yeah, if we get the kind of expectations, the market kind of solidifies what it expects going into the FOMC, and we don't see these constant 25 to 75% expectations, then I think we could have that where we have that second leg up. But we really need to get past the debt ceiling. We need to get past the Mueller investigation, which I think is going to really be drawn out as we get into the presidential election. So get kind of behind that. I think the economy still looks pretty good. A lot of the numbers are still positive. We get some more clarity on that next week. Then yeah, we could continue to see move higher, but we really need to get some of these catalysts behind us.
All right, it'll definitely be an interesting back half of the year. Andrew, thank you so much for joining us on MTL. All right, that's Andrew Thrasher, portfolio manager at Financial Enhancement Group, LLC.